Welcome to the next in our continuing series of videos on reflections on investments. And today I'm going to take you through what is probably the most important equation in all of investing. Yes, I know it's an equation, and some of you probably won't like that, but I think you're going to discover that it's well worth it. It'll help you understand your investments, and it'll help you understand what you can expect from the market going forward. So let's get started. I start with P here, and I'm going to be working with the S&P 500. So you can think of buying an exchange-traded fund or buying a Vanguard index fund or whatnot that tracks the S&P 500. The equation will work for individual stocks, but it's easiest to explain and to see how it works if we do it for the market as a whole. And that's probably of most interest to everybody, because virtually every investor has some exposure to the overall market. So P here is what you pay when you buy this S&P 500 fund. What do you get? Well, I'm going to write that down as C1. I'll explain what these C's are in a minute. Plus C2, plus C3, and so on. Now, what these C's are the cash flows you get by being an owner of the fund that tracks the S&P 500. And what are those? They're two things. Put them on the chart here. They're dividends and buybacks. That's all you get. You may say, wait a minute, what if I sell the fund? Well, then you'll get whatever it's worth at that time, but whatever it's worth at that time will be those cash flows going forward from there. So the total value of the fund for investors today is given by these cash flows. But there's something else to consider. The problem is you pay your money today, you don't get the cash flows till next year, the year after, and so forth. So to compare apples to apples, you need to discount those future cash flows back. So I'm going to do that now. For C1, I divide it by 1 plus K. And K is the discount rate. I'll explain that in a moment. For C2, it's 2 years, so you divide it by 1 plus K squared. For C3, it's 3 years. You divide it by 1 plus K cubed. And that gives you the present value of those cash flows, which should be equal approximately to the price you paid. Now, where's this discount rate come from? Again, two parts. Part number one is a risk-free rate of interest, often given by the Treasury bond rate. Right now, that's about 1.6%. Plus a risk premium. Stocks are risky, investors demand a premium, so there's the risk premium. And I'll get to in a moment what that is. So the discount rate is the sum of the Treasury bond rate and the risk premium. Now, how does this relate to the market today? Well, let's hold these cash flows constant, these C's. They don't change very much over time. In that case, P and K determine each other. If K goes up, you're dividing by a bigger number, and P goes down. Now, what's been happening in the market recently in terms of P and K? And this is where it gets really interesting. So let me go to a chart here posted online by my colleague, Professor Aswath Damodaran of NYU. So here's his chart, and this line here is that risk premium. You can see it started about 5%, went up as high as 8% during the height of the COVID crisis. By the end of 2020, it was down to under 5%, And just last week, it's 4.22%. Professor Demoterin has plotted this since 1990, and that's the lowest it's ever been. So what happens when the premium gets low? When K is low, P is going to be very high. And that's exactly what we see today. Now, the reason this is important is a lot of people say, this is the time, I want to be in the market now. The market's done so well. This is where I can make a big return. This is where I can build my wealth. Well, not so fast. The reason the market has done so well is the risk premium has gone down dramatically. And the risk premium is what you can expect to get. So in today's market, the prices are very high, but what you can expect to get is probably about as low as it's been in 40 years. So the past history is not an indicia of what you can expect going forward. Instead, the equation gives you an idea that the K is as low as it's ever been. So I hope that's helpful, and I hope it gives you some insight into investing in today's market. Thanks so much.